Welcome. Hello, everyone. Welcome to our discussion of Chapter 1 in our Accounting 203 Income Tax Accounting course. So we want to introduce you to the whole concept of income taxes. So this semester we are going to focus on income taxes. There are lots of different types of taxes, but we have to kind of narrow it down so that we can actually get through this. So we're going to be looking at the rules and laws regarding income taxes. So going back to a little bit of history, first had an income tax in the United States in 1861, went away after the Civil War ended, so not much went on. Okay, so it was kind of a temporary emergency measure because of the cost of the Civil War. Okay, again, 1894 tried it again, and the Supreme Court said, no, the Constitution does not allow for an income tax, generally on everyone. Okay, so Congress went back to the drawing board and passed the 16th Amendment, ratified by the states in 1913, and so we updated or changed the Constitution such that an income tax would be possible. Okay, and then of course it became they passed a law, and everything was ready to go. Here we are, 100 years later or more, and we now have 158, or at least in 2020, which is the most recent year available. It's always a little bit slow in getting all the data out about the returns, but 158 million individual income tax returns were filed that year. 94% of them were filed electronically. So by far and away, the majority of them are now filed electronically. That has gone up every year, and now it's almost all of them. There's only those who very a few folks, and then there are some situations where you cannot file electronically. And on those returns and tax returns, the amount of taxes paid by individuals was $1.75 trillion in 2020. Okay, so you can kind of do some math, figure out how much per return on average, that sort of thing. But the main thing is this is a large enterprise, obviously, to deal with all these different situations. 158 million individuals. We already have lots of laws. We have lots of technology innovations involved to try to make this work. It has lots of challenges, lots of difficulties, but for the most part, we're going to try to figure it out, at least the basics of it this semester. So first of all, we need to understand the overall tax equation, and to do that, we kind of introduce some terminology. Okay, so you figure out what your tax base is, or taxable income is, the income tax, and then you multiply it by a tax rate. Okay, so there could be multiple rates depending on the income. Okay, so a progressive tax structure, which is what we have here in the United States currently, is the tax rate increases with the tax base increase. It means you pay a higher percentage of your income in taxes based depending on what your income is. So you can't just take taxable income, multiply by a tax rate. You have to take it by multiple different tax rates, because some part of your income may be taxed at one rate, and then if your income is higher, the other additional income may be taxed at a higher rate or a different rate. Okay, so that's what we mean by progressive. The more you make, the higher percentage you pay. Is a progressive. Proportional is the same. No matter what your income is, you pay the same percentage. You might hear this referred to as a flat tax. Okay, Many states have a flat income tax. For example, in Pennsylvania, we have a flat income tax, meaning it's the same rate for everyone. Sales taxes are usually the same rate for anyone, regardless of whether you buy something a large amount or a small amount. Okay, it's the same percentage. So if the percentage is the same, regardless of the amount, then that's referred to as proportional or a flat tax. Regressive is a situation where the tax rate decreases. The more income you have, the lower your rate is. Social Security is kind of not sort of an example in that your rate drops after you reach a certain amount because that extra amount is not included in the calculation of your Social Security benefits either. So it's Social Security is thought of as a tax, but it's also a retirement plan, if you will. And so your benefits are based on a certain amounts of income. So that regressive tax structure is pretty rare, actually. Most countries have either a flat tax or a progressive rate tax structure. So if we were to look at what that ends up being, what happens with people's income, we have a difference between what the average tax rate is. So the total tax you pay divided by the taxable income equals your average tax rate. In a flat tax, that average tax rate and your marginal tax rate would be the same because everybody pays the same percentage. But in the marginal tax rate in a progressive is going to be different than the average because the average is going to consider what rate did you pay on all your income. Marginal tax rate is only what rate are you paying on the next dollar. So what tax bracket are you in, for instance? So we refer to the different rates as tax brackets in the United States. And so, for example, a married couple, okay, based on their income, would, if they made $83,551, that $551st would be taxed at 22%, because that's just into the 22% tax bracket. All right, and we'll show you a little bit of an example of what those look like a little bit later. Okay, we have examples in our textbook at the back in the appendix. As referred to in your textbook, there is the tax tables and the tax rate tables. The tax rate table shows the tax brackets. So whenever you are referring to marginal tax rates or asked in the homework to calculate, look at marginal tax rates, you're going to go to the tax rate tables. You're not going to go to the tax tables. All right, it's a little difference. So this is our income tax formula. So to get to calculating how much our tax liability, of course we multiply the tax rates, but before that we have to know our income. Then we need to subtract any permitted deductions from income to equal our taxable income. That's going to give us our tax multiplied by the tax rate, and again, it could be multiple rates depending on our income. Then we're going to apply any tax payments we've already paid, for instance, what is withheld by your employer, or other tax credits, because tax credits do not impact the taxable income. They impact our tax liability. So the tax credits are applied against the tax liability, and if our tax payments and tax credits are higher than our tax liabilities, we'll get a tax refund. If our tax liability is higher than our tax payments and tax credits, we will have to pay in with our return, or at least we should. Okay. Every year, then, individual taxpayers file a Form 1040. That includes several schedules, depending on how complicated your situation is. They all kind of are helping calculate the basic income tax formula. All right. So if we go to a copy here of the 1040, you'll see what it looks for 2022. And literally, it follows what we just talked about. It gives information about you and your family. Then there's the income, right? And they have some specifically listed. Add them all up, including that sort of thing. And then, okay, you have a standard deduction or itemized deduction. That's the permitted deduction part. All right, is on line 12. Then we've got some other deductions, and then the taxes. This is your taxes and certain credits. Calculate your tax, and then payments. So at the end, you end up with either a refund or amount owed. This is what Schedule 1. Notice that this is Schedule 1, talks about additional income. So we had a few things listed directly on the 1040. This is a whole bunch of other types of income, all of which gets added up and gets put over on the Form 1040. So every one of these schedules refers to a particular line back on the 1040. Okay, there's a second part of Schedule 1 with their adjustments to income. All right, we'll talk more about those when we get into the detail of the accounting, or the tax equation in later chapters. Let's get back to our slides. So, looking at income, things like wages, salaries, tips, commissions, bonuses, all kinds of things. Most of us receive a W-2, which reports income that should be on the return. So think of that tax return as settling up with the government at the end of the year. So you're going to take and put on the tax return what it is that you earn, income you earned. You're going to calculate what your taxes you owe based on that income, because it's different depending on what your income is. So we don't know absolutely for sure what our tax liability is until we know what all our income is for the year. So the end of the year, we have this tax return which settles up, says this is what we had as income. These are our permitted deductions. We may not know all of those until the end of the year either. Okay, subtract those, figure out our tax liability, and then compare it to what we already paid in the form of payments through withholding or whatever, however we made those payments. Other ways that things are reported, the W-2, you're familiar with that. Typically got it. If you get interest income, you may get a 1099 INT. Unemployment, 1099s G. All of these documents then come from various places to report what our income is so that we can match it up on the tax return to what actually happened. For right now, the only deduction that we're going to allow is the standard deduction, and we're just going to talk about the idea that amount is $12,950 for single and $25,900 for married filing jointly. Okay, so that's the only deduction we know of yet. Chapter 5, we'll talk about itemized deductions. We'll remind ourselves that you either use the standard deduction or the itemized deduction. whichever is higher, and that there are other standard deduction amounts that we need to worry about, but we'll talk about that in Chapter 2. For now, this is the only two numbers that might come up on our homework as we just get a taste of what it's like to calculate our tax liability. Now, once you have your taxable income, then calculating your tax, you use one of two methods. You can either use the tax tables if your taxable income is up to $100,000. That is the way you're supposed to if your income is up to $100,000. All right. Shown in Appendix D, as well as in the instructions for Form 1040. You can find it lots of different places. If your income is over $100,000, then you should use your tax rate schedule because the tax tables don't show anything over $100,000. Okay. There is going to be a little difference if you calculate. You can use the tax rate schedules for under $100,000. However, it will differ a little bit from the tax tables. And officially, you are supposed to use the tax tables to actually know how much to pay. So looking at the tax table, this is a tax table. This is not the tax rate table. This is a tax table. And so you find your income, taxable income, and you see that there's ranges, 400 to 450, 60,400 to 60,450. And then you need to know whether you're single, married, filing jointly, which are the only two things we've learned about so far. Married, filing separately, and head of household. And then that's the tax liability for a single individual with taxable income between those two amounts. So they don't calculate the tax liability for every number between 60,400 and 60,450. They just say anywhere in between those is this amount. Well, that's not exact. That's somewhere in between the two. That's the middle point. Okay. Now, if you're using the tax rate tables, this is for income over 100,000. This is actually in the IRS. Looks a little different than what's in our appendix. You can use either one. Okay, and appendix for the textbook. But the idea is you apply a different rate based on what the income is. And this is kind of a worksheet that would allow you to either set it up like in Excel with these formulas to calculate and figure out what it is your tax liability would be. Notice it starts with $100,000 in the IRS's publication because you don't use the tax rate tables in their estimation until you have taxable income over $100,000. When you look at the ones in your textbook in the appendix, they are all income levels because to illustrate how they work, and so you can practice with them. So you're going to have several homework problems where you're going to use these either tax tables or the tax rate tables to do some calculations to just get some practice in how to use these things. So most folks pay their taxes, their payments through the year through their withholding, and it's on the W-2. So the two most important things that report on your W-2 typically are the income that your employer paid you and the taxes they withheld from that income. Okay? There could also be some other things that are kind of considered tax payments like earned income credit. We'll talk about those credits in Chapter 9 in more detail. Okay. Also, just to review the idea of the settling up tax return due on April 15th. So you've got some time after the end of the year to kind of gather all your information for the past year and be able to work it out, find everything, do calculations you need. Okay. And then determine whether you paid enough in or did not. Okay. So when you get money back, it's called a tax refund, not a tax return. The tax return is the actual thing you file, which is basically a report settling up with the government or the IRS for the year. Okay. it would be great if the tax law about what is income and what the credits apply and what deductions are allowed stayed the same, but it doesn't. And this is just an example of the things that have happened, a couple of things that happened over the last couple of years. It's probably not going to carry over to 2022 returns, but a good example of a law that was in place just for 1 year was this American Rescue Credit, for, $1,400. It had limits based on income. It gets phased out, and things like that. So a bunch of rules, but that's very typical of what credits are. Most of the time, it happens and it's going to affect several years. But this is an example of a one-time deal, affected only 2021, but still going to maybe show up as some people may even got it late and could impact 2022.